Okay, guys, let me get back to some of the points that I covered last time, which is in topic 4, part 1. The first thing is about bypass offer. So basically, a bypass offer, like we discussed last time, it is unsolicited and not preceded by negotiation between the management of the two companies. So, I mean, you can think about tender offer, it's one type of bypass offer because it doesn't involve the negotiation between the management of the two companies and directly goes to the shareholder. So this is bypass offer. And this paper finds that Target, whose CEO was also the chair of the board, were more likely to receive bypass offer. So one of the reasons is that the acquirer here might believe that the management was entrenched and hence more likely to oppose the offer. So I mean they don't I mean they just don't waste the time talking to the management, right? And directly go to the shareholder. And they also find that offers made to the targets that had largely independent boards were less likely to be successful, and the initial offer premium surprisingly is likely to be lower than the less independent counterparts. So this was essentially saying that if you have more independent boards, right? These independent boards, they are more like um, they're more kind of neutral, or they also kind of commit to their fiduciary duties more. Right? So in that case, they might put a like stricter criteria in terms of approving the offer or not. So this is what the paper find. And also what they find is that bypass offer they were more likely to be successful and also feature greater gains for the target shareholder. And this actually supports the intuition that basically bidder, right? I mean, bidder usually employs an investment banker in the merger acquisition, right? So in that case, with the help of those financial advisor, bidder can usually get a good sense of whether a target is going to be receptive to an offer, right? So I mean, he can get kind of that kind of assessment more clearly. So that's why they are more likely to be successful. Right? So it's all about whether bidders know about a target so that they can better understand the chances of winning or chances of having the bypass offer approved by the target shareholder. So this is the first thing. And last time we also talked about tender offer, like the structure of the tender offer. Let me clarify another thing. Yeah, so here this is challenges for the Oracle, right? So remember the case that we talked about. Um, so we also talk about the structure of the tender offer. Right? You have a two-tier tender offer, which is a way to force the target shareholder to tender offers early. So this is that. Now we also talk about the wealth effects of unsuccessful tender offer. So this paper by Bradley, Desai, and Kim, 1983, is a paper that tries to analyze the returns to shareholders by firms that either received or made unsuccessful control-oriented tender offers between 1963 and 1980. So this is what this paper did, and I mean they actually include also control-oriented tender offer, right? So that is the offer where the bidding firm holds less than 70% of the target shares and is attempting to increase the holdings by at least 15%. So they include both these types of offers. What they find is that target shareholder, they obviously realize positive returns right, surrounding the amounts of the announcement or tender offer. But that's only, I mean, that's mainly for the firms that are subsequently taken over for these guys, right? If you're not taken over, you have a little bit of positive reaction in the first or second months, but that quickly disappears, right? And they also look at the cumulative non-return to the bidding firms, right? So this is for the bidding firms. The title on the book, it's a little bit confusing, but let me clarify this. This graph is for the bidding firms. So for bidding firms, they also look at a CAR, right? So that is to look at the days relative to announcement. So what they find is that the bidding firm's cumulative normal return remain negative when the target is independent and there's no change in control. So this is kind of saying the bidder has tried, but it failed. Right. So now if you tried but you failed, it's not like you lose to somebody, right? But when another bidder acquires the target and the bidder loses the tender offer, then the value of the bidding firm falls. All right. So this is losing. This is losing to another bidder. So this is kind of saying that, well, you made a tender offer, but you actually lost to another guy, right? So that kind of suggesting that you actually lost an opportunity to acquire a valuable resource, right? If you made a tender offer, but I mean you don't lose to anyone, the target remains independent, right? It's not like acquired by another bidder. In that case, this is like I mean, maybe the target doesn't want to be sold in the first place. Maybe the target is so resistant, right? So it's not like the bidder manager's fault, right? It's not like the bidding firm's fault. But if another bidder, right, outbid you, right, and then they acquire the target instead of you, right? In that case, investors tend to attribute this to the bidding firm's failure, and this was a like negative reaction because the investors might feel like the bidder loses the tender offer to another bidder, right? So in that case, the market reaction tend to be negative, right? So that is the idea. Because these are the first two things. And finally, we also talk about bad bidders more likely to become targets, right? So this was asking a question, right? If you made a unsuccessful tender offer, now the question is, are you gonna more likely to become targets, right? So do bad bidders turn into targets more likely in the future? All right, so this paper by Michaud and Lane, 1990, find that the probability of becoming a takeover target was inversely related to the CAR of the acquisition. I mean, that was kind of saying, if you make bad acquisition, you're more likely to be subject to the takeover pressure. You're more likely to become a target. You're more likely to be acquired by another company, right? So I mean, part of the reason you can think about that is if you made a bad acquisition, the bad acquisition will actually make your performance very poor. It will like drag down your performance, right? In that case, in the future, if you have bad performance, then you're more likely to be the target. So acquiring firms that did not subsequently become targets show positive returns, right? So that was like the mentality was like you don't become the target, right? That potentially suggests that so the reason that you do not become targets because you made good acquisition, right? You make good acquisition, you have a good manager, your performance is good. That's why you don't become targets, right? And if you become targets of acquisition, no matter whether you are the targets of a friendly acquisition or you're the targets in the hostile acquisition, you show negative return. Right? So that's kind of saying if you made a bad acquisition, right? So that shows two things, right? Either you actually overpay for the target firm, right? So that seems to suggest that the managers are not so good. The manager's talent is there's some problem with the manager's talent. The second thing is they're saying that the managers might not pick the target well, right? The managers may make those opportunistic acquisition that are not in the best interest of the shareholder, right? But all of them are suggesting that acquiring firm is not good, right? Acquiring firm have some kind of problem, right? Either because the acquiring firm does not perform well, or it's because the acquiring firm manager have some problem, right? But later they become targets, right? So that means, I mean, it's either because maybe because the managers are not doing so well, because the managers might suffer from agency conflicts, right? So that in the future, the market for corporate control came to them to replace the manager, right? Another acquirer will try to acquire this bidding firm in order to replace the poorly performing managers, right? So this is one possibility. So right, so this is kind of interpretation of the evidence, right? So this in this graph is showing that, right? So this is looking at a bidding firm's an announcement return, right? This is looking at whether they become targets in future acquisitions, right? In the future, right? Now, if they become targets in acquisition, right? They are the bidding firms announcement return when they make acquisitions, they are negative, right? If they do not become targets, then they're making better acquisition, right? That's kind of that's like the fact that you don't become targets proves that you are making good acquisitions, right? And then on the other hand, the fact that you're making good acquisitions means that you're a good manager, and hence you don't become targets, right? That's kind of an idea. Okay, that's kind of the things that I want to clarify for the last time. This time we're gonna we're gonna talk about two things. We're gonna finish the takeover tactics. So we're gonna talk about shareholder activism, the proxy fight, as one of the takeover tactics, and then we're gonna talk about chapter 7, which is the hedge fund activist. All right. So if you look at chapter 7 is hedge funds as activist investors. Right. So we will talk about this chapter as well. So after this class, after this week, we'll potentially finish the part 1 and the part 2. All right. So this is kind of the plan. Now let's move on to finish the takeover tactics. Right. So last time we talked about one of the takeover tactics, or one of the more aggressive takeover tactics, is using the proxy contest, right? So what is a proxy contest essentially, right? So what is a proxy? The question boils down to what is a proxy, right? A proxy is a document that authorizes one individual to act on behalf of another, right? So normally that means, because there are many institutional investors that hold some stocks of a public company, right? But because like mutual funds, hedge funds, or those big funds, they hold hundreds of a company, right? Typically in a proxy season, there are hundreds of annual meetings happening there, right? It's impossible for these funds to vote to vote on their to vote by themselves for every annual meeting that is happening in the proxy season, right? Now, in that case, they have to delegate this voting right to a broker, right? So in that case, the broker will vote on behalf of the institutional investor, right, in the annual meeting. Now, this is what the proxy is used for, right? The proxy is usually a document that authorizes the broker to vote on behalf of the institutional investor. All right, so the proxy card basically contain certain required and brief information regarding the specific solicitation being made, right? So what is the solicitation here? This is usually called a proxy solicitation, right? It refers to the request that the shareholder authorizes another person, usually it's a broker, to cast the shareholder vote in a corporate annual meeting, right? So this is a proxy solicitation, and this proxy solicitation is written on this proxy card. So if it's a merger, right? In the merger, there will be shareholder meeting. So in this shareholder meeting, this information must include the term and the reasons for the merger, right? So this is the proxy card. So then what is the proxy fight, right? So essentially a proxy fight, it's like this voting case, right? It's like the annual meeting case, but the difference is that they don't happen like annually, right? So in this proxy fight, basically there will be voting going on, right? So sometimes there will be like specific meeting going on, which is to decide on certain issues, right? Like merger acquisition. That is a very important issue. So in this proxy fight, it's essentially a very aggressive battle between the management and the shareholder, right? So it's an attempt by the single shareholder or group of shareholders to take control or bring about other changes in the company through the use of the proxy mechanism of corporate voting, right? So it's like in this proxy fight, right? If you are the shareholder, you wanna, let's say you send a tender offer, right? Let's say you send a tender offer, but the management established a poison pill, right? Which makes your acquisition very costly, right? Now you have no other solution, right? You have to go to a proxy fight to ask other shareholder in order to ask other shareholder to vote in favor of this tender offer, right? The other thing you can do is that you can ask other shareholder to kind of replace the current management with your preferred candidate, right? You can propose one candidate, and then you will ask other shareholders to vote on this new candidate. If other shareholders they also approve this candidate, director candidate, you can put this candidate on the board, right? Now in that case, you can change the board dynamics, right? Because you have one candidate that is voting in favor of your merger, voting in favor of your tender offer on the board, right? So in that case, this board of member might this board of director might try to push the board to remove the poison pill. No, right? So after they agree to remove the poison pill, then everything becomes easier, right? Now the merger acquisition can grow more smoothly, right? So this is why sometimes we need a proxy fight to address the issue, right? To push for merger acquisition to go through. Yeah? So in a proxy fight, a bidder might attempt to use his voting rights and garner support from other shareholders to oust the incumbent board or management. All right. So this is in most cases what the proxy fight is used for, right? Sometimes you want to oust the incumbent board, right? Which is to, let's say, we want to replace the management, right? This is a proxy fight. Or you want to replace a certain member on the director on the board, right? Maybe this director is against the merger, right? And then he doesn't want to approve the removal of the poison pill, right? So this is why this will happen in a proxy fight. And the regulation actually gives shareholder this kind of right? So the rule 14A8 provides shareholder with a mechanism to have their proposals included in a company's own proxy statement, right? So basically, this gives shareholder the right to have their proposal including in a company's own proposal in a company's proxy statement. Now, so the proxy statement is issued to all shareholders, right? So because let's say on an annual meeting, right? On the annual meeting, the company has to issue a proxy statement. In this proxy statement, the company has to list all the shareholders' proposal, right? Which include in proposal, for example, to let's say replace a certain management, replace a director from the board, right? So it's proposals like that. Right? Now this is shareholders' rights, and it's not very costly because for any small shareholder with a very low threshold, I mean, as long as you spend as long as you have like $2,000 in terms of your portfolio, right? You can put up this proposal. So it's not very costly. It's very cheap. But of course, the managers also have ways to fight back, right? So managers, they can sometimes petition the SEC to have it issue a no action letter, right? So no action. I mean, there are many reasons that the managers can use to push for the SEC to issue a no action letter, right? For example, one excuse could be that so for example, the shareholder is trying to push for the management to lower the compensation, right? So then one of the reasons the kind of company can use is that this similar matter has already been discussed in the previous annual meeting, right? So we don't see any necessity to bring this up again in this annual meeting, right? So this is kind of idea. In this proxy statement and in this proxy fight, the insurgents or non-management activists, right? So non-management activist basically refers to external shareholder, right? Now, in order to do this proxy fight, they have to file a schedule DFAN 14A, right? So this is a form covering non-management proxy solicitations not supported by the company. Right, so because I mean in proxy fight you can imagine, right? You want to replace the manager, right? Who I mean, nobody in the company will support you, right? So that's why you have to submit this form, schedule DFAN 14, right? So to kind of solicit, to kind of do proxy solicitation, right? So this is the idea. I mean, meaning that you authorize the broker to kind of to vote on behalf of you, right? So, and this SEC Rule 14A allows the shareholder to put their nominees on the issuer's board through a 2-year, 2-step process, right? So this is how shareholders replace the board member. So the first step is that the shareholder submits a proposal to adopt customized proxy access. I mean, this is the first step in the legal procedure. The second step would occur in the next year when the shareholders would use the proxy access process to put forward their own board nominees, right? So this is the second step. Right? Now, over time, so there's a there's a historical trend in terms of the frequency of proxy fights, right? Now, so we already talked about why firms use proxy fights, right? So sometimes to kind of push for the merger goes through, right? If you have a tender offer, the management has a poison pill. Now you want to do a proxy fight to remove certain director that also to replace certain directors so that the poison pill will be removed, right? So this is one very typical case, right? The number of proxy fights over time, they increased significantly over the period 2005 to 2009, and then decline again, and then increase again in the years leading up to 2014, right? And then decline again. So part of the reason why there is an increase in the years leading up to 2014 is because there's a growing number of aggressive hedge fund activists, right? They are trying to use this proxy contest mechanism to bring about changes in undervalued companies. So we will talk about this hedge fund activism in the in later this topic, in this part. So, and I mean, in order to do hedge fund activism for hedge fund activists, they use this kind of proxy contest mechanism fairly often, right? So that's why we see a increasing the proxy fight, right? Now, there are different kinds of proxy contests, right? For example, one type of proxy contest is contest for seats on the board of directors, right? And this can be used to replace management, right? And then there could be contests about management proposals, right? For example, on annual meeting, there are two kinds of proposal. One kind of proposal is called shareholder proposal. The other kind of proposal is called management proposal, right? So usually management proposals are proposed by managers by definition, right? And in many cases, they are passed with high voting percentage, right? The reason is that usually those institutional investors, they're usually delegating the right to vote to the broker, right? And then usually brokers, they side with management in the voting, right? So that's why it's very easy to get very high support for management proposal. And these management proposals, in very special cases, it could be control proposals relating to the merger acquisition. Right? It can also be a anti-takeover amendments in the company's charter. All right. So in those very special cases, then the shareholder, they can issue a proxy contest, right? And also, like in the first type is that they can also use proxy contest for seats on the board of directors, right? For example, they can replace certain director. They can nominate their own director, right? So this is the case. So like we said, right? So the rise in the proxy contest can be partly explained by the number of hedge fund activists, right, that have been using the proxy mechanism to bring changes to the company. So this is the number of contested solicitation that we talk about, right? And from the insurgents' viewpoint, so what are the insurgents? Insurgents are typically also like dissidents, right? The shareholders that do not agree with the manager's stand on the merger acquisition, for example, right? So from the insurgents' viewpoint, there could be some kind of reasons why they want to use the proxy contest, right? For example, insufficient voting support, right? So so when I talk about, so just now, right? So when I talk about proxy, like management proposal, right? I say that typically, right? Typically, management proposal, they can pass with a very high percentage, right? Because management, they can count on their own votes, right? Because management have ownership in the company as well, right? So, and so in that case, they can count on these votes, right? They can also count on the votes for uninstructed brokers, right? So these brokers, like I said, it's the broker that votes on behalf of the shareholder. And usually these institutional investors, they don't give specific instruction for those broker, right? They will just ask the broker to vote. So then if you have insufficient voting support, usually the proxy contest will be successful, right? But so in that case, I mean, typically, if management and they have a high ownership, or they have large votes for uninstructed broker, this insufficient voting support is not going to help the proxy, the insurgents, right, in the proxy fight, right? Because I mean, like I said, they can count on their own votes and the votes for uninstructed broker, right? So, but I mean, in other cases, the insufficient voting support could actually help proxy insurgent or dissident, right? So this is situations like if the management do not have a strong block of clear support for the management among the voting shareholder. If they don't have block holder who support the management, then insurgents have their way to go, right, in the proxy fight. And another thing that might increase the likelihood of proxy fight is poor operating performance, right? If the company is poor, is performing very poor, right? This is hard evidence that the managers do not do a good job, right? So then shareholders might actually be sympathetic to the insurgents so that they will try to vote for the proposal to replace the current management or replace certain members in the board of directors, right? And the other factor that may increase the chances of winning in the proxy fight for the insurgent is that if the insurgent have a sound alternative operating plan, right? So you want to replace the current management, right? But the shareholder, they don't know what's the alternative, right? I mean, if you have an alternative candidate that is sitting on the board, right? You don't, I mean, the other shareholder, they don't know whether this alternative will perform better or not, right? Now, if you have plans that could improve the performance, right? If you have an existing plan that can improve the performance, that will send a more convincing signal to shareholders, right? For example, so one of the plan could be asset sales, it could be higher dividends, or it could be removal of rentee takeover barriers, right? So these are all the alternative plans that can potentially improve the performance of the company, right? So in that case, if you launch a proxy fight, that's going to be more convincing for the shareholder. And the other thing is that the distribution of the shares has a greater impact on the success of a proxy fight as well, right? So if there are several activists that have amassed significant equity position in a vulnerable target, then this activist, this insurgent has a lot of leverage. They have a lot of advantage, right? Because they have the shares, right? I mean, they have most of the shares on their hands. So it's easier for them to push for any changes they want, right? Now, on the other hand, if the employees or certain institutional investors who do not actually favor or who do not actually support insurgents, right, whom actually support management, now in that case, it will be difficult for the insurgents. Right? So there are papers who look at shareholder activism, so which later we'll talk about much greater details about papers that look at the empirical evidence of the wealth effect of shareholder activism later, right? Now we're going to focus on a little bit evidence now, right? For example, this paper by Pound in 1989, he uses a sample of 16, right? So which is a very small number, counter solicitation proxy fights by shareholder groups that occurred in the 1980s, right? So what he found is that the counter solicitations were more successful than they were so they're more unsuccessful, right? So I should say this again. So counter solicitation, they were successful more often than they were successful, right? So in other words, they're more likely to be unsuccessful, right? And the problem is that when the shareholders approve the contested provisions, the net of market share values of the company dropped an average of 6%, right? So in that case, that seems to suggest that the counter solicitation were unsuccessful, right? So these shareholder activism doesn't seem to increase shareholder value, right? Doesn't seem to be favored by the shareholder. And the majority of the counter solicitation that Pound examined were preceded by a direct attempt to take control. All right, so what is counter solicitation? Counter solicitation are essentially proxy fights. Right? So solicitation is initially for the manager, they essentially first they will put out a proxy solicitation. Right now, the shareholders, the dissidents, the insurgents will put a counter solicitation that tries to uh, ask the shareholder to oust the current boss. Right? This is kind of idea. So now we're gonna compare some of the tactics we saw earlier, right? So tender offer, it's a way to it's a takeover tactic, right? So another takeover tactic we have just talked about is using the proxy fight, right? Now, what is the cost? What are the costs of a tender offer, right? Tender offer are costly because they offer to buy up to 100% of the outstanding stock at a premium, right? This premium could be as high as 50%, right? Now, in a tender offer, the bidder might have to sell the holdings if the tender offer is unsuccessful. Right? So this is the cost of tender offer. If the bidders sell their holdings, right? If the tender offer is not successful, then the bidder has to sell the holdings. Now, in that case, they might actually take a loss, right? So that is kind of ideal. So the alternative tactic we talk about just now is using the proxy fight, right? A proxy fight might be a less expensive alternative to a tender offer, right? Because I mean, in a proxy fight, you don't have to acquire 100% shares, right? You can launch a proxy fight even if you only have 5% of the target company, right? So in that case, a proxy fight can maybe a less expensive alternative to a tender offer, right? But the problem is that if the tender offer fails, right, you might actually recover some of the cost of tender offer. Right? For example, if the target share price goes up, right, you might actually recover some of the cost of tender offer. But if you do a proxy fight, these costs are not recoverable, right? You do a proxy fight, you fail, then it's not recoverable. You mean, as these costs include professional fees for the services of proxies and solicitors, investment bankers, and attorneys, right? These are the typical costs of conducting a proxy fight. Now, in those proxy fights or proxy counters, this kind of leads to the birth of another occupation, another kind of type of industry, which is proxy advisory firm. So typically, these kind of firm, they provide advices in proxy fight, advices in the annual meeting, right? And then what they do is that they provide advices and recommendations for how to vote in a proxy fight, right? So the ISS, the Institutional Shareholder Services, and Glass Lewis, they are the two major players in this industry, right? And often the recommendations of these firms are blindly accepted by institutions. And for example, this paper by Lacker and al., they find that the companies that follow the recommendation had a lower market reactions than those who did not, right? Which seem to suggest that if you blindly follow the proxy advisory recommendation, that does not necessarily result in greater market value, right? Sometimes, I mean, they might actually, because I mean, they have to make recommendations for many clients, right? So sometimes they might actually made recommendation that are more consistent with managers' perspective. Right? So that's why the market reaction are low. So proxy season usually are annual meetings that happen in April or March, right? So this is a typical proxy season, right? And for example, in 2013, there were more than 800 proxy proposals submitted to public company, right? And currently, the rule is that the shareholders who have a 2,000 investment in a company have the right to make a proxy request of the company, right? You can see the threshold is pretty low. As long as you have 2,000 investment in a company, then you are good to make any proxy contest. And another number here is that 93% of the shareholder proposals that came to a vote at Fortune 250 companies in 2013 were actually denied. So, which means they do not pass. Right? So you can see, I mean, shareholders, they make efforts, but in some cases, they're not very successful in persuading other shareholders to vote in favor of the proposal. Now, there are many researchers that look at the shareholder wealth effect of proxy contests. And in early research, for example, Dodd and Warner, 1983, they found a positive stock price effect that is associated with proxy contest. So this is some positive evidence for proxy contest. D'Angelo and D'Angelo, 1989, they find that average of normal shareholder wealth increase equal to 4.89% in a 2-day window around the announcement of the dissident activity. So, which seems to suggest that maybe investors, they can guess what the dissident will do, right? The dissident might actually replace the bad managers and improve shareholder value. Right? And fewer than 20% of the company remain independent and under the same management 3 years later. Right, so that seems to suggest that dissident actually has a point, right? The current management of the company that the dissident file a proxy file might actually be bad managers, right? So that's why in the future they might actually be taken over. They might actually be bought by another firm. And at many of these companies, the CEO or president have resigned, right? So that seems to suggest there's some positive value brought about by these shareholders, by these insurgents. And later researchers find other evidence, right? For example, Bostat and Swilling find that dissidents were successful 42% of the time, right? So this number was significantly higher than the early periods, right? And shareholders, they realized just over an 11 rate of return during the contest period, right? Seem to suggest that the dissident really has a point where, I mean, the current management might be the reason why the company is undervalued, right? And Moharan Post in 1998, they find that the proxy contest actually help create shareholder value. Right? So part of the reason is because maybe these proxy contests, they're targeted at those undervalued firms, right? And the reason for this undervaluation is because the managers do not do a good job, right? So that's why companies want to file a launch a proxy fight. And gains were even found when a company was not acquired, right? If that firm experienced management turnover, right? So that seems better managers, they are being replaced. That's why there are gains, right? And then the new management tended to engage in restructuring, right? Which also created shareholder value. So in general, we have positive evidence for proxy content, right? It's a way for the shareholder to improve the shareholder value. I mean, even though it's a more aggressive way than just like submitting a shareholder proposal, annual meeting, right? And in general, the success rate of proxy contests increases, but they have a slight drop after 2015. Yeah? And so we have been talking about insurgents, right? But who are those insurgents or who are those dissidents, right? Usually the dissidents are often formal managers of the target or those who have prior experience in the target's line of businesses, right? So those people who know the target fairly well. Right? So otherwise, they cannot convince the shareholder that the current management is not doing well. Right? And almost half of the contests, they were waged between former insiders who left the company following a policy dispute or other disagreement, right? So in other words, they want to take over the control, right? So they want to take back the control, right? So that's kind of idea. Because the
the previous manager is not doing well, right? And in almost 50% of the contests in their sample, the dissident leader had the prior experience in target line of businesses, right? So that seems to suggest that the dissidents or insurgents actually know the target fairly well, right? So that they can convince the shareholder that their candidate or the current management is not doing a good job, right? Otherwise, because shareholder usually have information symmetry between the manager and the shareholder, right? So the managers know more about the company. So in our case, if you have a dissident who come from the target firm or who actually has experience in target businesses, right? That might help them to convince the shareholder that the current management is not doing a good job, right? And this paper by D'Angelo and D'Angelo, they look at the long-term effects of proxy contest. So what they found is that dissidents prevailed in 1/3 of the contests in their sample, and another 1/3 of the company, they had changes in the top management within the 3 years of the contest, and with most of these changes occurring in the first year. So there is a real consequence of proxy contest, which is that a substantial of the company, they actually do have changes in the top management. And only 20% of these firms, they remain independent. So now you can see these tactics are fairly effective, right? They're effective in replacing the current management and subsequently facilitate the occurrence of a merger. Right? So remember, this is one of the tactics people use in a merger, right? To get a merger approved from the management. And because tender offer and the proxy fight, there are two kinds of tactic, we will wonder what determines the role of a tender offer versus a proxy fight, right? So proxy contests, they tend to occur more frequently in cases where the company's performance has been poor. And I mean, if we talk about performance, that's measured by the stock market performance and the return on assets, right? So these proxy contests, they tend to occur more frequently in cases where the company's performance were poor, right? And these proxy fights, they are tended to be associated with managerial inefficiency. And proxy fights targets, they're less profitable than targets of tender offer. So in general, the targets of proxy fight, they are poorly performing. Right? So that's why the insurgents need to replace the management, need to oust the board. Right? And I mean, on the other hand, the poor performance of these proxy fight targets gives the insurgents, gives the dissidents a more compelling reason for changing the management or enacting other changes, right? So that makes it more convincing, in other words. And because proxy fight is very effective, we can actually combine proxy fight with tender offer in acquiring a company. Right? So basically, the hostile bidder may actually use the proxy fight to effect the approval of a shareholder proposal that actually might dismantle the target's anti-takeover defenses. Right? So in that case, the proxy fight might actually replace a certain manager who installed this anti-takeover defense, right? Now, if that director is gone and the new director that like the merger, he might actually make decisions. He might actually push other directors to make decisions that might eliminate those anti-takeover defenses, right? Now, in that case, it will make the tender offer to go through more quickly, right? And another benefit of combining a proxy contest with a tender offer is that, so in that case, it might be beneficial to do so for the bidder to replace the target director who opposed the bid, right? So this I already talked about. So proxy contest can also be used to replace the target board and have a new director redeem a poison pill that might be inhibiting the bidder's tender offer. Right? Now you can see this is really the reason why people sometimes use the combination of tender offer and the proxy fight. Right? And proxy fight also have the disciplinary effect. Right? For example, this paper find that when the likelihood of a proxy contest increases, companies implement various changes, such as increasing leverage, dividends, and CEO turnover to improve the performance. Right? So this is the spillover effect. Now we move on to talk about hedge fund activists, right? So let's take a short break.
Okay, the second part is we're gonna look at hedge fund activists. So why do we talk about hedge fund activists? Because they are very special. They're very special type of active shareholder or activist, and this is a very like like it's a growing trend for activists to be involved in shareholder activism and even in merger acquisition. So we're gonna talk about the macro foundation of the growth of activist funds. And we'll also talk about the leading activist hedge funds and institutional investors. We'll also talk about hedge funds that are involved in the merger acquisition. And then we're going to talk about activism and the firm performance, right? Finally, we're going to talk about the bio premium between activist hedge funds versus private equity firms. So this graph shows the number of hedge funds over time. You can see over time, there's a dramatic increase, right, during 2003 and 2007. Then after that, it remained at a similar level. Right? And hedge fund, the assets, the value of the hedge fund assets also increases dramatically, right? So this is, I mean, in 1990, it's only like very little, but in 2016, it reached like 3,000 billion, right? That's a lot. So, and also we can look at the recession, right? So the activism hedge funds perform well in the post-recession period, right? And show better performance than any other investments, right? They improve dramatically. And when we look at the activist asset under management, so this is how many assets they are, I mean, what is the value of the assets they are managing? Again, there's an increase after the crisis, right? There's a dramatic growth in the assets they manage as well. Yeah. And this is the number of activist campaign, right? So later we'll talk about what is a campaign, right? So, but in from after the financial crisis, we can see there's a after the financial crisis, there's a slight decrease, but then there's a dramatic increase over time, right? The number of activist campaign. So first of all, the macroeconomic foundation after the 2008 is that we have a very severe downturn during the financial crisis, right? But now after 2009, the growth picked up and the US economy regained the momentum, right? So, and in that case, because after the crisis, many firms they are go bankrupt. Some of the firms they even, they are sold out to another firm that they go bankrupt, right? So there are many cases like that. So in that case, there's a huge difference between good firms and bad firms, right? So the strength in the equity markets was good for most of the company, but some of the laggards, some of the company that cannot catch up with the growth opportunity in the equity market cannot are kind of slowing down, right? So then many of these companies become the focus of opportunistic activist funds. So that is one kind of macroeconomic foundation. And the other macroeconomic factor is that there is a low interest environment post financial crisis, right? And then this low interest environment made the cost of debt financing lower for the potential acquirers, right? So in that case, activists, they want to, they either buy the targets themselves or they will be involved in a merger acquisition. For example, they can provide a financing to another acquirer, right? The low interest environment help them to do so, right? Because if you have low interest, it will be easier to raise financing. Now, what are the leading activists, leading activists in terms of hedge fund activists here, right? So the kind of leading activists that we typically might know it already from the news, right? Carl Icahn, David Ahern, Bill Ackman, as well as Nelson Peltz, right? So these are very kind of famous hedge fund activists, and these activists they have been in the hedge fund industry for a long time. And there are also other institutional investors who actually are involved in this wave of hedge fund activism, right? For example, Coppers and Costers, these are very famous pension fund investors. And then from time to time, they support hedge fund activists in the hedge fund activist campaign. And that's why they also benefit from the activism. And some of these leading activists, they are very aggressive and public in their approach and may launch an attack at a company, following up with immediate blitz to put maximum pressure on the target management and the board, right? So usually what they do is they will accumulate some shares of the company, right? Let's say 2%, 3%, right? Now, if they accumulate 3%, 2%, one way they could do is they can choose to accumulate to up to 5%, right? And then in that case, they file a 13D filing, right? Because their holdings are above 5%, right? They can submit a filing 13D. Now, in that case, in the 13D filing, they'll specify what they will do, right? After acquiring the shares of the stock. Now, in that case, after they disclose this, right, they will talk with the management. They might send a public letter to the management stating that their objectives, right? For example, the objective might be to push the company to pay out more dividends, right? So this is one purpose. Now, there could be multiple rounds of negotiation going on between the management and the activists, right? And if the battles between company and the activists become more aggressive, right, more kind of fierce, now the next step tactic is using a proxy fight, right? So like we just talked about, the hedge fund activists might use a proxy fight to try to replace some members on the board of directors, and then nominate their own directors who favor their policy, who favor their proposed changes to the company. Right? And in most cases, during the negotiation or before the campaign become more fierce, more kind of confrontational, in most cases, company will reach a settlement agreement with the activists. So, for example, the activists won the board seats, right? So the company might satisfy their demands by agreeing to kind of having two nominated directors from the activist funds on the board, right? So now the policies of the company might be influenced by the hedge fund and so on, right? Now, after a year or 2 years, activist hedge fund might actually exit from the company that they target, right? Because hedge fund activists, because they're hedge funds, they are typically short-run oriented, right? They don't focus on long-run performance. Even if their actions to intervene in the company might result in an increase in the long-run performance, but typically their holding periods of the stocks in the target company are typically short-run, right? So they expect to profit from the short-term stock market increase from the time they start to intervene into the company and the time they exit from the target company, right? Sometimes during this process, their proposed changes might actually be accepted, right? So this will cause the stock price to increase. So these are some of the tactics. A less kind of confrontational tactic might be if you acquire 3%, right? You stop there, and then you talk to the management, right? And and in that case, you don't want to make it very public, right? You just secretly talk with the management, right? And this may actually put a more toned down battle for the changes they're looking for. Right? So these are the leading activists we just talked about. And the disclosure requirement for the activists. So there are in general two tactics here for the activists, right? One tactic is that they will directly accumulate shares more than 5%, right? This is when they have to disclose their holdings, right? They have to file a 13D. And in this 13D filing, they will disclose their holdings and disclose their intentions of accumulating those shares, right? And another type of tactic hedge fund activists use is that they will try to accumulate shares below 5%. Now, in that case, they need to file a 13G filing. So 13G filing is usually for passive investor, right? You want to buy some shares of a public company, but you don't have a strong intention about what you do, right? Now, in that case, you might choose to file 13G filing of a passive investor. So in that case, you don't have to disclose what you're going to do with these holdings, right? Now, typically, one tactic of hedge fund activists is that they might try to first file a 13G filing, Now, over time, when they see the market timing is good, right? When they see that when they see that there is opportunity to intervene to the company, to talk with the management, to change the company, now they will accumulate more shares and file certain DeFi. Right? So these are the two tactics activists typically use. And there's a changing nature of the activist targets. So traditionally, hedge fund activists, they target smaller firms, right? But this pattern changed in the years 2012 to 2014. And companies as large and as successful as Microsoft and Apple, they found themselves the target of activists, right? So actual activists, they began to target smaller firms, right? And part of the reason for activists pursuing larger targets is because with larger funds and much greater AUMs, right? We see this trend of growing AUM, right? Then if they target larger companies, they can produce more significant returns, right? So this is one of the reasons. And there are good points, there are bad effects of hedge fund activism, and there are critics, there are people who kind of favor the hedge fund activism, right? The good thing is that the hedge fund activism pressures the company not to amass assets, but to distribute it to shareholders, right, in the form of a buyback or special dividend. So this is the good part. So shareholder might benefit from this, right? But it can also be bad, right? So it can also be bad when companies are prevented from pursuing a viable long-term plan due to the short-term pressures of activists. Right? So this is when, because I mean, like we said, hedge fund activists, they're usually short-term oriented, right? Like 1 year, 2 years. After 2 years, they will just go. Right? Now, if they focus too much on improving the 1 year return, 2 year return, they may actually sacrifice long-run plans, long-run shareholder value. Right? And activists acquire position and usually have a near-term exit strategy, right? Like I just described. And they want to pressure the company to take action that will cause the stock price to rise and enable them to exit the investment at profits. Right? So critics contend that this can be a short-termism, right? So the long-run probability in the growth of the company might be hurt by the changes that activists proposes. Right? And later, when we talk about literature, we will show that on average, that's not the case, right? The proposed action by the hedge fund activists are actually, on average, long-term value. I mean, on average, they are long-term value enhancing. And activists, they believe that this kind of performance of the company, it could be attributed to the past management. And this mismanagement has created opportunity for the activists, right? So their argument is that it's because the previous management, they focused on too much on the short term. They have agency conflict. That's why their growth and opportunity have been weaker, right? So that's why activists they intervened and make positive changes. And one typical activist campaign is activist campaign for board seats, right? So activists investor would acquire shares in the target and then try to gain board seats. Right? One example is when William Ackerman or Bill Ackerman and his activist firm, Pershing Square, right? So Pershing Square owns 10% of Chipotle. Chipotle is a US kind of Mexican grill franchise, right? And then his firm demanded and got 2 seats in the board of directors of Chipotle, right? And then they actually form agreement with the Chipotle. In this agreement, Ackerman and his firm agree not to comment publicly about the firm for a period of 2 years. Also, because the firm was afraid that any comment made by Bill Ackerman, it will be a sign of Ackerman trying to intervene in the company, right? So trying to say the company is undervalued, right? And this agreement also restricted Pershing Square, this company, from raising the stake above 12.9% over that same time period. Right? So, and
what about the directors nominated by activists, right? So they are typically often people on the payroll of the fund, right? They're from the fund, including possibly the head of the fund, right? They can also be industry experts or people who have been employed in the industry for a long time, right? So they're very familiar with the industry. So after activists gain seats on the board, the next most common demand is the return of monies on the balance sheet to shareholders, right? For example, paying out dividends or like altering dividend policy, right? So that's one possibility. So this graph shows this example of activist campaign, right? So this is activist campaign initiated by Star Board. Right? The target is Darden restaurants. Right? So you can see these are the series of events, right? For example, on December 19th, Smith begins a major accumulation of Darden shares and caused the company deeply undervalued, right? So typically, the motivation for activists to enter into a company is because they believe the company is undervalued, right? That's why they want to propose changes that they believe will improve the value of the firm. Right? So that this is kind of the idea. And next event is on May 16th, 2014, right? Darden's board vote to sell Red Robust for 2.1 billion. So like I said, as asset sale, it's one way to improve the firm value. Right? So that was kind of the idea, right? So then on May 22nd, Smith says the Starboard, Smith is the manager of the Starboard, the kind of hedge fund, right? And we'll begin a campaign to remove the Darden board, right? So then next in the next following months is these are the kind of battles for replace the board members of like Darden restaurants, right? So finally, on October 10th, Darden shareholders vote to replace all 12 directors with Smith nominees, right? You can see this is a very successful proxy fight, right? Because the hedge fund activist wants to replace every director from the company, right? And then finally they succeeded. And so one of the tactic, like we say, is that the activist wants to replace a few board members, right? But let's look at in another setting, right? So when we talk about anti-takeover defense, right, we say that if you combine stagger bots with poison pill, that's going to be very powerful, right? Because in order to have the poison pill removed, you need to kind of have a director that is in favor of the removal, right? And sometimes that's very difficult. Now you have to remove a certain director that approves the installation of the poison pill, right? But it's very difficult because in a stagger board, each director they're elected every 3 years, right? So in our case, if you wanna if the majority of the board they are in favor of installation of the poison pill, that means it takes a lot of years to replace the whole board, right? But for activists, they don't have to replace the whole board, right? They can potentially accomplish their goals by replacing just a few key board members, right? And on the other hand, outside pressure have forced many companies to abandon their stagger boards. Right? So over time, you can see these are the classified boards of SP 1500 firms, right? Now, over time, you can see more and more firms that are becoming like declassified, they become unitary boards, right? The classified boards become less and less. So because there are efforts to force company to eliminate classified boards, right? Especially at a larger company. Right? So next, we're gonna look at a very special situation where the hedge fund activists they are involved in a merger acquisition, right? They are acquirers. So as hedge funds, they began to feel the pressures from competitors to generate high return. They started to look to take over. Because takeover, you can see when we look at the risk arbitrage in MA, right, the typical return is very large, right? So if you are an investor, you typically, if you can push the company to be engaged in a merger acquisition, that's an even better deal, right? So for example, Edward Lampert, through the hedge fund ESL investment, did a blockbuster takeover of Kmart. So Kmart at that time was emerging from bankruptcy protection. Right? So this was one case when the activists, they were, um, I mean, it was like acquired by itself, right? Another example is Nelson Peltz and the Trial hedge fund leveraged position as active shareholder to acquire Wendy's in 2008, right? Now, finally, they also merged Wendy's with Arby's to form Wendy's Arby's, right? In 2011, they sold off Arby's to a private equity firm, the Raw Capital Group. And of course, they benefit from the stuff. Right? So these are the cases where the hedge fund activists, they are acquired by themselves, right? But more kind of frequently, they team up with hostile bidders, right? So, for example, William Ackman and his Persian Square Fund team up with Valiant Pharmaceutical to make a 45.6 billion unsolicited bid for Allergan, right? And Bill Ackman brought special capability to the deal, right? Because at that time, the acquirer, Valiant Pharmaceutical, they don't have much financing, right? The deal was mainly financed by Ackman, right? So Ackman brought financing, but also skills developed from being a highly successful health activist over many years, right? In terms of the skills to buy a target company, right? So they combined to purchase 9.7 as a toehold in Lurgan, right? So this is a target firm. So 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 you can see this is a strategy that can actually benefit activists in two ways, right? When the deal passes through, right? So this is good news for the activists, right? Because the acquisition is successful, right? Now, even if the acquisition is not successful, um, so even if the acquisition is not successful and the target is sold to another company, now in that case, the profits also are very handsome, right? Because we all know that when a merger acquisition happens, target usually enjoy positive return, right, around the announcement. Now in that case, because activists they have stakes in the target company, right? They also benefit from this, right? And over the period of February through April, Ackman and Valiant acquired a 4.99 stake in Allergan. Right? The bulk of the capital was advanced by Pershing Square. And because, because in this case, 9.7 actually was higher than the 5% threshold, right? So in that case, Ackman has to file a 13D filing, right? And during this 10-day window of 13D filing, Ackman and Valiant acquired another 4.7 stake in Lurgan, right? So this is how they came up with this 9.7 holdings in the Lurgan, the target company, right? Ultimately, the deal is not successful, right? This company, Allergan, was bought by Activities, right? But Actman did win financially as Allergan's largest shareholder, right? Because obviously you can see Allergan's stock prices goes up dramatically during the merger, right? So Actman still make profits. So in general, when we analyze the impact of activist hedge funds on activity, there are two considerations here. A very common scenario is that one or more hedge funds acquire a share position in a company they believe is undervalued, right? And in that case, they might seek a short-term return through actions such as forcing the sale of the company. Now, if they push for a sale of the company, that might increase the overall volume of the M&A activity, right? On the other hand, if the target wanted to pursue a strategic merger that would pay gains in the long run, the hedge fund might actually oppose the deal. Now, this opposition might actually lead to a lower overall level of the M&A. Yeah, so this is the two kind of scenario when we try to explain. And many of the activists, they just want a company to do very basic things, such as to use the cash on the balance sheet to buy back shares, to pay more dividends, right? To sell some of the assets, to make sure that the short-term performance of the company improves, right? The operational activists may get more deeply involved in the company's operational performance, right? In that case, they might want to have the company run differently, right? For example, they might want to say, so I remember there was activist campaign where Bill Ackman pushes one company to spin off two divisions of the company, right? One division was wine businesses, the other division was like golf businesses, right? So the activists want to push for the company to spin off these two divisions, right? So this is a case where it's like a typical operational activist. So this paper by Boyson, Gencher, and Shivdasani 2007, they find that activist hedge fund interventions significantly increase the probability that the target will be taken over, right? Because the activists they accumulate some shares in the target firm and they become the shareholder. And when this takeover was implemented by a third party, the target received high bids, right? Because activists they can also try to push for higher premium, right? So I mean, this is also their tactic. And also there was a higher percentage of completion of deals that were initiated, right? They make sure that deals are completed. And even when the bid failed, the operating and equity market performance of the target improved in subsequent years. Right? So this was also interesting, right? So this is like the activists untapped the potential of the target company, right? So it was trying to show to the market that the target was undervalued, right? The way to achieve the value, one way is to sell the company, right? Then even if the target is not sold, there might be, I mean, the managers are becoming more disciplined. The managers, the managers have this wake up call of this merger attempts, right? So they will try to improve the company in the long run. So there are many papers that look at the shareholder wealth effect of active share funds. In general, the conclusion is that there's positive shareholder wealth effects, both in the short run, and also in the long run. This paper by Brav, John, Thomas, and Padnoy, 2008, find that the announcement of hedge fund activism was associated with 9% abnormal returns. Right? And this paper by Clifford, 2008, find that companies that were targeted by activists realized higher excess stock return. Right? And firms that are targeted by activists, they experienced almost like 3.5% CAR around the announcement date, right? So this is a short-term market reaction is good, right? And even so in the long run, they also find many improvements, right? And these improvements, like the ROA is becoming better, Topic4 is higher. And many of these improvements, they are through the divestiture of the underperforming assets. Right? And this paper by Klein and Nazir, 2009, compared the market effects of activist share accumulation with those of what they call entrepreneur activists, right? So what are the entrepreneurial activists, right? This group consisted of individuals or asset managers acting on their behalf, right? Like private equity firms and venture capitalists, right? And hedge funds show a 10.2% returns, while the entrepreneurial group was associated with a 5.1% return. And for both companies, the returns did not dissipate over time, right? And hedge funds' abnormal returns 1 year later were 11.4% and 17.5% for the other group. Right? So, I mean, it seems that hedge funds, they do have short-term returns, but in the long run, entrepreneur activists, they actually perform a little bit better, right, in terms of the returns. Another finding is that hedge funds, they tend to target companies that were in better financial condition, right? Not like firms that are in financial distress, right? And they seem to seek out companies that had higher cash resources, right? They try to pressure them into buying back shares and make other changes like lowering senior executive compensation and increasing dividends, right? But entrepreneurial activists, they tend to focus more on the company's strategy, right? Like changes in the R&D projects, right? Changing the innovation strategy, right? And Greenwood and Shaw 2009 find that announcement returns are greater than 5% for those companies that were eventually acquired, right? And the ability of the activists to generate excess return or generate alpha is mainly due to the fact that the target is being sold, right?
the fact that the target is being sold is the reason why the activists can generate excess return. Because we know that when the target is being sold, or even if the target announces that they plan to be sold, there will be a positive return, right? So Brav, John, Partnoy, and Thomas find that the market reaction to announcements of the campaigns, right, they are positive, right? Average of number equal to 7%. The performance also increased. There's also greater CEO turnover, meaning that the bad managers are being replaced, and the increased use of pay for performance, right? So CEOs, they're more their incentives are more strengthened, they are more disciplined, right? So they also find that the evolution of ROA and the Q, they're becoming better, right? So there's an increase in, on average, there's an increase in ROA and Tobin's Q, right, after the campaign. So finally, previous paper, they also compare the buyout premiums between activist hedge funds and private equity firms, right? And hedge fund activists often have impacts on these leverage and private equity buyouts, right? Because sometimes activists might oppose the takeover bids by private equity firms, right? Based on the reasons that they think the bids are just too low, that they are not sufficient, right? So this paper by Huang 2010 finds that a 1 standard deviation increase in the fraction of equity of the target that is held by hedge funds was associated with a 3.6% increase in the buyout premium, right? So the more hedge funds involved in the company, the greater the buyout premium, right? Because hedge funds usually they might push the board director to argue for a high premium, right? They might even sue the company's board of directors if the board of directors do not compete to bargain for a high premium in a merger negotiation. And the holdings from other investors do not have these similar impacts, right? So now we're gonna talk about the role of institutional investor, right? So not the hedge funds, right? There are other mutual funds, pension funds that have holdings in the company as well. So a growing percent. So over time in US, the percentage of retail ownership is declining. So there's a growing percentage of equities that are owned by institutions as opposed to retail investors, right? And it's also very concentrated. A few very large institutional investors has a very concentrated ownership in large companies, right? So therefore, you can see their support for activist initiatives is very important for the success, right? Because I mean, if the shareholders of other shareholders like mutual fund, they don't support activist campaign, then it'll be very difficult to have the shareholders approve the proposed changes of activists, right? Because I mean, typically activists only buy like 10%, 20%, right? That's already a lot, right? I mean, if no shareholders vote with them, it will be very difficult in a proxy fight, for example. And so that's why getting the support of institutional investors is very important for hedge fund activists. Another perspective researchers look at is serial activists, right? So this proves that hedge fund activists, their success comes from like experience, right? Experienced activists, they have both higher short-term and long-run performance in terms of the campaign. Now, there's also papers that look at or anecdotes about wolf pack activism, right? So this shows that activism or hedge fund activists, they don't act by themselves, right? They usually act in a group. So a group of hedge fund activists might act together to kind of coordinate on this campaign, right? The idea is that there's a lead activist in this campaign, right? which is typically the filer of the certainty filing. And then the lead activists, they recruit other investors to join the campaign, right? So then what are the benefits of other activists, right? The other activists, they are compensated by the expected jump in the stock price in the certainty filing announcement, right? So that's what they are being compensated, right? Now, Now, by inducing other investors to acquire shares of the target, the lead activist might be able to accumulate a larger percentage of de facto ownership before triggering regulation thresholds. Right? A very kind of interesting tactic is that, let's say you have like 5 activists, right? And then they talk to each other, and they might act together, right? So, so the lead activists, they might actually accumulate 6% of the target shares, right? So this crosses the 13D requirement. Now the lead activists might have to file this 13D filing, right? Now the other activists, they might actually accumulate 2%, 3%, 4%, right? Separately. So if each of them accumulates 3% separately, right? They don't have to file 13D. Now, how they are gonna make profit, right? They still have 3% they still have like 3% holdings for each activist, right? So then each activist, they can profit from the time that the lead activist filed this 13D filing, right? When they file this 13D filing, the stock price goes up. So the rest of the other activists, they actually can benefit from that, right? Now, in that case, you can see the lead activist or the activist as a group has a much higher holdings now, right? Now, right? Because if you count all the 5 activist holdings together, right? One activist 6%, the other 4 activists, each of them like 3%. Now, in that case, the activist group has like 18% of the company, right? So now you can see no, the activists as a group has a much higher chance of winning, right? Because they have a much stronger ownership, a much stronger power in influencing the management, because they have almost close to 20% ownership, right? They together may actually be the largest shareholder of the company, right? So that's why previous study they have found out the presence of a wolf pack is associated with a significant 6% increase in the success of the campaign and a higher buy and hold normal return. And this wolf pack are more likely to occur in better defended company, right? Because this is a more kind of secret way to circumvent the regulation, the 13D requirements regulation, and to win, right? So this leads to the issue of communication among actors, right? So they may tip each other off on their views on particular company, right? So for example, stock roses on average 3.2% over a 10-day period before the bullish announcement, right? So when activists makes a bullish announcement, other activists may follow, right? So this causes the stock price to increase, right? And then if there's a bearish announcement, the stock goes down, right? Now on the target side, target manager usually they're resistant to the activists, right? Because activists wants to replace the board of directors, right? So this paper by Boyson and Bichola 2006 find that this kind of target resistance includes poison pills, classifying the board, or changing voting requirements. Right? So in our case, it's the same thing with poison pill in MA, right? When the poison pills were adopted, they will trigger percentages that were just above the shareholdings of the activists. So in that case, activists cannot increase their holdings anymore, right? Because as long as the activists, let's say, crosses the 7%, then the poison pill is activated. Now it becomes much more costly to acquire further shares. Because in this activist campaign, acquiring more shares is also very important, because the more shares you own in the target firm, the greater say you have in the negotiation with the target manager. Right? They also limited the ability of other shareholders or actors to team up against the target, right? Because you have this poison pill there to kind of say across this percentage you cannot accumulate more shares. And in the negotiation, the target management might also seek to enter into settlement agreement. And this settlement agreement usually includes a standstill agreement, right? So in this standstill agreement, it will freeze the active share accumulation for a period of time. So that says, I can agree to your demands, but you cannot accumulate shares anymore, right? So this is kind of standstill agreement. Now, finally, there's also positive peer effect. So that is, this paper find that there's significant positive externality to spillover effects. So peer company that would potential targets change their financial behavior, right? They increase their leverage payouts, and they also lower their cash holdings, right? Because I mean, they know that if they have high cash holdings, activists may come to them and push them to pay out the cash, right? So that's why they reduce their cash holdings in advance, right? Their ROA and asset turnover also improved along with their valuation, right? So that they are not undervalued anymore, right? So to kind of circumvent the threat from activists, right? So this is kind of my idea. Okay, this is so much for topic 4.